Mavericks. This is Rob Reinhold. I'm joined by Mr. Darren Fisher. This is the Trading Room, and August is now officially over. I can't believe that this year's gone by so quickly. Not just this year, but summer. I just cannot believe that summer is basically gone. But I'm actually really excited because I don't typically like August trading. And this year, August is actually quite a good trading month. But a lot of the years, I just hate August trading. So whenever Labor Day comes, I am like so ready to go because typically the market has been pretty lousy going into August. After Labor Day, you typically get, a pickup in volatility, pickup in movement, a strengthening of trends. And so I'm really excited for the trading that's likely going to be coming down the pipe here over the next couple weeks. Before we jump into trading, we got to talk fantasy football. All right, now look. We do 2 sporting events every year at Maverick. We do fantasy football in the NFL in the fall, and we do March Madness. Now look, if you're one of our traders and you have no interest at all in fantasy football, just ignore this and just go along with your life and just have a great life. For those of you that want to play, you already have emails and invitations to come and join us. Grand Champion is going to get $300 gift card to Amazon. All the league winners are going to get $50 gift cards. Now, when I started doing this 8 years ago, someone brought up a suggestion. I thought, okay, that'd be cool. I didn't care about fantasy football. I didn't really watch NFL at all. And I got into it. And I am embarrassed now of how big of a deal this is in my life. I'm embarrassed. I tell people like, hey, I can't go out that night. I've got my draft. Like, they're like, what? You have a draft? Like, for the Army? I'm like, no, for fantasy football. It's embarrassing. And one of my favorite things was a couple of years ago, I was trying to explain it to my wife, who just didn't understand it. And so I explained how it all worked, and she says, oh, so it's like Dungeons and Dragons for jocks? And I said, yep, you pretty much nailed it. So look, if you're one of our traders, like I said, you've already got invitations. Come join us. If you don't want to join us, that's fine. Come join us on March Madness, or don't join us for any of our things. We do 2 sports things every year. If you have any questions, get in contact with Corey or get in contact with myself. All right, well, let's talk trading here. Over the past few weeks, we've been paring back our bullishness. So 2 weeks ago, we said, hey, you know what? We need to become less bullish because we're entering into seasonally weak periods of time. The week after that, we pull back to neutral. So last week, we were at a neutral, but we said we're probably going lower. And sure enough, we said, hey, we think we're going to go about 1.5% lower before we go test the 50-day MA. We broke through support at 4,000. We broke through the 50 MA. And the stock market had a pretty nasty week last week. And all of this has been since the Jackson Hole Symposium, where Chairman Powell really came out and said, hey, you know what? We're not backing off on interest rates. So we've seen the 10-year rise all the way up to 3.2, 3.3. I said a couple weeks ago, anything over 3 is going to be very negative, especially for technology, high-value stocks, and they've definitely felt it. On Thursday, we got this big reversal. We reached a real big low. The market reversed and actually eliminated a 1.5% drop and closed up for the day. And then on Friday, we got the jobs report, and the market was up 1%, and it completely sold everything off and ended almost at its lows. So that is just a real good sign. When something has a good, solid bounce, and then the next day there's no confirmation, it's telling you it wants to go lower. We take a look at what happened in the economic reports last week. We have some job stuff, but really the big numbers here I'm going to point out are Thursday. We got the ISM number that was slightly better than expected. That actually caused the market to feel buoyant for about a day. And then on Friday, we got the jobs report. Now the jobs report, the headline number came in pretty much as expected. 315,000 jobs were created. I saw anywhere from 290 to 320 were the estimates for job creation. But the thing that the market liked initially was the employment rate ticked up. It ticked up 3.7%. And at the first of the morning, people were hopeful that, oh my gosh, maybe this means that the Fed won't be as aggressive And the market actually was up about 1.2% in the morning. And then throughout the day, it just sold off, sold off, sold off. And it ended up being a really, really ugly day. So when we take a look at what happened last week, a lot of failures to hold on to any sort of rallies that the market tried to put through. So let's take a look at the charts. Let's take a look at certain levels and see what we're seeing out there in the markets. All the numbers last week, we had the Dow down 2.8%, S&P down 3.2%. As I said earlier, the NASDAQ is definitely getting hit even harder, down 4%. The Russell small cap stocks hit even more. And take a look at the tumble in oil and gold. This was just a straight sell-off across the board. Everyone pulling money out of assets because they don't think that the Fed is going to be all that friendly over the next 6 months. We take a look at what happened in the charts. As you can see here, we broke support of that 400 on the SPY, 4,000 on the SPX. We broke that on Tuesday, and we didn't recover at all. We kept going lower and lower, and we finally got this reversal candle on Thursday. And as you can see, on Thursday, I remember talking to a trader saying, hey, you know what? Yes, we've pierced, and I use the term pierced. We pierced the moving average. But a lot of times things will pierce and then they'll recover. Here's an example of where the moving average were pierced. We had 2 up candles and then recovered quite quickly above the 50. And that ended up actually being a pretty good bottom. So when things just pierce for a while, I want to give it a little bit of time and make sure it doesn't recover that line very quickly with some bullish action. If you take a look at Thursday, Thursday was the price action where I said, okay, here we are. We pierced below the moving averages. We got this reversal on Thursday. And on Friday morning, I thought, oh, we could potentially recover back above the 50-day moving average. Then I'm going to have to be more neutral still on this market. As you could see, we basically hit up our head against that moving average, and we sold off all day long on what was actually some fairly decent news. That is a sign that the market doesn't want to go higher. If we come over here to the NASDAQ, NASDAQ is looking even worse. We broke through, had our reversal, but we couldn't even get up to the 50. It didn't even get up that way, and we closed well below the open that we had on Thursday. So everything is showing more bearishness than bullishness. And when we come over here to the VIX, here we're seeing that we're just not all that bearish on the VIX. 26 is elevated, but it's not fearful. Darren, what's your call here on this VIX at 26 as far as with where the market is right now?
I think there's a lot of complacency and a lot of hope in the market. I mean, despite the price action, I mean, the price action Friday before a 3-day weekend to gap up and then just sell the rest of the day, no one's got the appetite to hold, but it's not reflecting in the VIX. There's just not enough fear in here. So I think we definitely have room to run. When we get back up over the, over 32, up into that 34 area, then I would take a look at calling a bottom. But you're right, it's elevated, but it's not panic mode. This does not look like a bottom. I think people are going to have to get even more hurt and hedged out before that we can even try to put in a bottom. I mean, I'll go out on a limb here. I think we hit June's lows by the 15th. I mean, that's a pretty bold statement to make, but that's what the market action is telling me right now, is that we're in for some near-term pain that's going to come very, very quickly.
You know what, Darren, it is a bold statement, and I love bold statements. Nothing drives me more crazy when people come on CNBC and they hedge all their bets, like it could be this, it could be that. Yeah, it's a bold statement, but I'm right there with you. Let's go over real quickly what the VIX measures. The VIX measures how many puts and calls are being bought on the S&P 500 futures contract. So it's basically a measure of how many people are buying insurance to the downside if there is a crash. So the measurement is saying that people aren't fully hedged. Now remember, if people are fully hedged, now what that means is you take another position that benefits when the market crashes. So if your portfolio goes down, your hedge goes up the same amount, you don't have a loss, and you don't need to sell anything. You don't need to liquidate things. You don't get pushed out in margin calls. What this is showing here is that portfolio managers and the public are still net long. They're still net long, and they're not hedging their portfolios aggressively, which means if the market drops lower, they're going to be forced to liquidate some. They're going to be pushed out. And as long as they aren't hedged, they're going to be forced to sell. Now, what happens is it gets so intense, like up here at the 32 and 34 area, that everyone just scrambles and runs and gets hedged. Once they get hedged, they no longer need to liquidate, and then the market stops going down. So I'm with you, Darren. I think there is a very big potential of a fall over the next 2 weeks, and it really lines up with seasonality patterns that we've been talking about for 2 or 3 weeks now, that September is the worst month of the year, and we've seen the most crashes in the month of September. I'm right with you. I think we could easily see something near the June lows in the next 2 to 3 weeks as well. So as you can tell, we are both fairly bearish, and we have here the markets are almost bearish. This is where we talked about this last week, Darren, where I said that I'm bearish. I feel very bearish, and I use the term feel on purpose. Yes, I could have written you an essay on all the reasons I think we're bearish, but the technicals weren't showing bearishness. They were showing caution. They were showing be neutral. That's why we've dialed back from a +2, from a +1, back to a 0 last week. The question is, have the technicals broken? And the answer is almost. I know that's disappointing because a lot of times as traders, we say, oh, I have a good hunch. I'm going to follow it. That's great, but that's a terrible way to trade. We need the technicals to get just a little bit more bearish, and then I'm telling you, the green light to go short is on. I think we're likely going to get that this week, but we're not quite there yet. And that's why I'm looking at things saying, hey, you know what? I'm not quite ready yet. We'll look at that and we'll talk about it. Markets are closed Monday for the Labor Day holiday, so it will be a holiday shortened week. And then add on Wednesday, we have 2 central bank governors speak. And both of these central bank governors have been more hawkish than the rest. I don't expect it's going to help the market at all this week. So if we take a look at the economic reports, we really don't have anything. We've got Mester and Brainerd speaking, and then we have Fed Chairman Powell speaking on Thursday. As I said, these have all been hawkish members. I can't imagine this helps the market out at all. So we were at a 0. We are now down to a 1.5, and we are ready to go to a -2 as soon as we get just a little bit more drop below that 50. The reason I'm saying that is that we were at the 50-day moving average literally 6 hours ago. I think it's a little bit too early to say we have truly broken and are going to hold below the 20-day moving average. Until that happens, I'm going to be at a 1.5. Once we get 1 or 2 more red candles on Tuesday or Wednesday, if that happens, I'm moving to a -2. And then once the 50-period moving average starts to tilt lower, I'm going to a -3. So again, I'm going to be following the technicals, not my opinion, but following the technicals before I get really bearish here. But everyone should already be tilting bearish at this point. We've got a -2 on the week. Darren, what do you think about that -2?
I like the -2. Just looking at Friday's candle. Looking at Monday, Tuesday, Wednesday's candle. I think you've got to be there. There's velocity to the downside here. There's volume to the downside. We might get some relief, maybe Wednesday or Thursday. I doubt it though. This thing looks like you've just pulled the plug out of the bathtub and the water wants to keep going down.
That's a good analogy. I like it. Let's look at some sectors, Darren.
Yeah, let's hit them. So kind of interesting here, tech. Yeah, as you can see, and this I think is reflective of the interest rates. With I think you called it, Rob, when interest rates go above 3%, these very marginal companies that need short-term debt, they get hit the hardest. They can't operate as fast and as efficient as they'd like to do. So tech, down 5, materials down almost 5 as well. Real estate was the third worst, down 4. I mean, these are all interest rate sensitive sectors right here. And so people are trying to bail out, and they're doing a really good job of it as well. I mean, the best performing sector, utilities, that was still down a point and a half right there. So that's where the strength is. I mean, in a down market like this, your strongest sectors are the ones that go down the least. Okay, this is all based on relative strength, relative weakness right here. But you can see, I mean, everything else was down at least 2%, between 2.5% and 5% is what every sector was. And you have to remember, there's a muting function in the sectors because you're taking from a bunch of different stocks make up these sectors. So to have these sectors down as much as they are, that there was some individual stocks that just got cut off at the knees. And so, I mean, your outliers would probably be down 13, 14% for the week, on some of these, some of the ones on the left-hand side of the bell curve. So just an ugly picture all the way around. But surprisingly, let's take a look at utilities itself. I'm still positive on utilities. It did come down. These range candles in utilities are some of the highest ones that we've seen all year. I mean, you just usually get very discrete movements in utilities. It dropped down to the middle, right in between the 20 and 50 period moving averages. Friday was an ugly day as well, but that's still strength. Look how far away it is from the 50 period moving average. This is the strongest sector out there, and we had a higher high and a higher low. We were still down 1% on Friday, but it was still a higher high and higher low than what we had on Thursday. So that there's definitely I would like to see a green candle to call it a confirmation. That's where the end of the bull pullback is. But I mean, you can do it. So I think +1 for utilities. It's looking good. If you're looking for somewhere to go long, I think your utilities are where you need to be. Communication services. We were at a -1 last week. I'm still at a -1. Okay, you could make me the case for a -2, but the reason I'm at a -1 is because you're at some pretty significant support right there at the 54 area right there. You can just draw it. So if we pierce below that, then I'm happy to go -2. But right now, I just want to see what it is. I think we drift down, or it just bounces around here like a rock on a lake. If it goes below that, I'm happy to get more bearish on communication services. Real estate. Real estate, I'm at a -1. The reason is, I want to see another down candle before I go to that -2. Real estate has been doing okay. It's been +1, +1, +2 over the past several weeks. So this has been one of the stronger sectors that we've looked at to go long. Let's see if this move below the 50 is momentary. If it is, then I can go back to neutral. If it keeps going down, I'm going to dial that up to a -2. Pretty short order right there. Industrials was at a 0 last week. I'm at a 0 this week just because we're barely below that 50 period moving average. The main body of Friday's candle was in between the 20 and the 50. So you could say we're at the 50. I would be comfortable making that declaration. We're at the 50, not above it, not below it. So I want to see, where do you go from here? And again, we're on a hair trigger on a lot of these things. Give me a couple more down candles. I'm going to crank things down. If we can hold up at least and go sideways, then I'm going to stay neutral. I just don't see any bullish upside right now. So a lot of things are in that wait and see mode where we go. Healthcare. -1 on healthcare. This one, firmly below the 50 period moving average right now. That 20 is about to cross that 50 as well. But it's been holding up. It's been going sideways in a pretty ugly market. It just, this is the first week that it really broke down. If I get market action like this, again, I'll crank it down to a -2. It's just, this is one that has been holding up. And remember, several weeks ago, we were above the 50, above the 20. We had this ranked at a +2 just because that was one of the strongest sectors. Technically, it looked like it was good to go. Obviously, it's fallen apart with the rest of everything here, but this is one that again, could go either way. Financials, yep, same situation as anything at a zero right now. We're at the 50. Okay, I can't say we're above. I can't say we're below. We're at that 50-period moving average right there. So I'm neutral on it. Let me see what you can do. I think it does go down, but it's holding up there. It's holding better than a lot of other stuff that we've been taking a look at. Consumer, you say the exact same thing. Some of these, if it's ranked at zero, some of these charts look exactly the same. You're at that 50-period moving average. That is the line in the sand where we say above it, we're bullish. Below it, we're bearish. When you're at it, you're just kind of on that teeter-totter. Let's wait and see what happens. Although tech not looking as good. I'm at a -1 on tech. I mean, this came down pretty fast. We were to zero last week because we were in between that 20 and the 50. This firmly went down. Again, we got that bearish engulfing candle on Friday. I mean, that thing is huge. Look at that. Very, very small amount of green on Thursday right there. You can make me the case for a -2. I would fully embrace that as well. I just want to see a couple more candles. This is one of the ones that is on the chopping block right now. One or two more red candles, and that -2 I think holds in there pretty well. Materials. This is another one. I'm in a -1 on materials. It's down there. It's below that 50. Kind of decisively so. Let's wait and see where the velocity takes it, though. This could turn into a -2 pretty quickly. The brightest spot in every sector, which has been for pretty much the entire year, is going to be energy right here. We pulled back to the 20-period moving average, and even though we were up 2% on Friday right there. I mean, take a look at that. Even though you've got a red candle there, you're still up 2%. And this is a classic bull pullback to a moving average. This is, it's +2 for me. We're above the 20. We're above the 50. We've just pulled back and confirmed. Energy and utilities are the place to be. Clearly, if you want to be bullish. Everything else, either neutral or actively bearish. So, rank everything again. At a -1, you got materials, technology, real estate, healthcare, comm services. Half of the S&P sectors are at a -1. 0, we're looking at consumer, financials, and industrials. Wait to see which way those things break. The only thing looking good on the bullish side, utilities and energy. Let's take a look at some possible trades. So in utilities last week, we were long Sabra, SBRA. And that was down 4.28%. But the good thing for that is that never triggered. And this is why in markets like this, in any market really, you've got to wait for those triggers. That'll save you. You might think you're missing out on gains. Really, you're missing out on losses. Okay, so always wait for those to triggers. We're happy that never triggered. What we're looking at right now is AES Corp. And the ticker for that is AES. We're at a nice high base. We're back at April's highs right there. If we can get through it, we're looking pretty good. I mean, we're right up there. We pulled back to the 20-period moving average in a basing action in a really ugly week, but we held in there pretty nicely. So possible trades. Go long the October 24s and short the September 26s to put a diagonal call spread if you get a big pullback on Tuesday. If you don't get that pullback, then still go long the October 24s, but short those September 27s if it's up on Monday. Right there. So comm services, last week we were short Verizon, and that turned out pretty well for us. That was down 4.5%. That looked really good. So if you're in that trade, you definitely know that one's looking pretty good. This week we're looking at Dish Network. This is in a low base. This has been on a low base since May. You can see we've come up, we've hit down, we've come up, we've hit it, we've bounced along it, and we're back down there again, right at that 17 level. I mean, if you could not peg anything, so there's support at 17. How long is that support going to go? Wait for that breakdown. But if we get that breakdown with the market action the way it is, I'm long those October 20 puts. That's where I think the action is. If you want to play it a little more conservative, you can just go out to September and do the 16-18 bear call spread. You're probably going to have $1 worth of reward and $1 worth of risk right there. Right in the middle is where you are. But that support at 17, it's probably going to break eventually. In healthcare, last week in healthcare, we were long CHNG. And in the week that we had, we could have played it two ways. Either played a diagonal spread or you could play it in at the money horizontal spread. Either one of those worked out really, really nicely because CHNG was only down 0.08%, essentially no movement for the week. So either one of those trades, you're probably looking at a max gain right there. Decide if you want to hold on to it or not, decide what you want to do with it. But for a 1 week trade, plain stagnation, we were quite happy with that. This week, we're looking at Cardinal Healthcare, symbol CAH. And you can see in a down week, this was up. This is one that's been really strong. Nobody gave Cardinal Healthcare the memo that it was supposed to be a down week. And we were basing between 67 and 70. And finally, on Wednesday, we broke out. Confirmation on Thursday, still looking really good. So I'm out there. I'm long the October 65s, and I'm going to short the September 71s or the 72s. That's going to depend on where we open on Tuesday. Probably going to be looking at the 72s, though.
Let's check out some trades in the industrial sector. Last week, we talked about a short position in Southwest Airlines, LUV. And it actually had a nice down move. It was down 2.1%. Everything's looking really good on the trade. There's one more week on the trade. Just a little bit more down. It is going to be a max gainer on LUV. This week, 3M. All right, now let's take a look at this chart, because this chart, sometimes these are the harder charts to trade because you get these big moves. As you can see, we had some earnings probably happen here at 143. Huge drop. No buying the day after, no buying the next day. We finally just got a little bit of buying on Thursday because the market was up. But look at this. I mean, just a really low base. I like to call these a low and tight base. One of my favorite patterns here. And you can see we completely engulfed Thursday's candle and more. This is just a nasty, nasty candle where we already broke some pretty major support here on 3M. So the question is, okay, well, how do you play that? And you can play it one of two ways. You can play it aggressively. And aggressively, you simply just go long the October 25 puts. You have your target. And when it gets to your target, you start to look at taking some profits on your positions. A little bit more conservatively, you can go out and take a look at the September 16th, 118, 122. So basically the stock's at 121. So if you do a 118, 122 bear call spread, this is going to be a delta dependent trade. You're probably going to get in somewhere around $3 in the credit. That means you're going to have about $1 of risk. And the stock has to move down. You've got 2 weeks for this thing to move down. If it closes below 118 on September 16th, you win $3. If it takes off and runs for some reason above 122, you lose $1. These are really conservative trades to make in fast-moving markets like we're expecting. That is 3M in industrials. In the financial sector, last week we had Capital One Financial, and we talked about using a targeted butterfly to the bearish side on Capital One Financial, and it actually hit perfectly. We had the 100, 105, 110 butterfly that closed on this Friday, and as you can see, the stock closed at 104.22. So that is about as perfect as you can get on a butterfly. Now, I assumed we were going to be looking at more butterflies in the financial sector because we've been doing butterflies for about the last 3 to 4 weeks in financials. However, I came across this one, Sallie Mae. And for those of you that don't know, Sallie Mae is the kind of the quasi-government company that guarantees student loan mortgages. Now, look, we've all heard the news of the student loan forgiveness. Look, I don't think that's that big of a deal on this because if it was, you would have seen the stock react. As you can see, the stock had no reaction when the news was announced, but maybe this is something that is hanging over its head. Regardless, you can see that there's a huge band of support here at the just below 15, and we are clearly looking to break that down. So to play this, the question is, how do you want to play it? I'm looking at just a 14-15 butterfly. To me, that's a pretty simple play. The stock's at 14.68. I'm probably going to get in somewhere around 55 or 60 cents. So my max gain is going to be 55. My max loss is going to be 45 cents. And I'm looking out at 2 weeks of holding this for just a little bit better than 1-to-1 risk reward. You could look at that targeted butterfly. I didn't look at the numbers, so maybe the numbers might not make sense. But if you want, take a look at a 13, 14, 15 targeted butterfly and just let this thing drift down. Understand that the targeted butterfly is going to be a lot slower trade, meaning there's not as much delta involved. Delta is how much an option moves based on how much the stock moves. A targeted butterfly is going to be a muted delta play where you're going to have more theta decay. So it's going to be less sensitive to price action. And if you let this thing drift down, it could be a really nice trade as well. So that is Sally Mae SLM in financials.
Last week in consumer, we were long ConAgra, symbol CAG. It's down almost 2%, 1.98%. So considering the movement of the market, it held up pretty good. This is one of those ones where, even if it's when you're down the least in a down market, you're actually the strongest. So there's, I think, another week or two on this trade. I'm going to keep it on, and we'll see where it goes. But that's why you size these things for max loss. Everything else is looking really good, and that's also why you basket trade as well. So I'm not dependent on one trade going my way. I've got a lot of winners. I maybe have one or two losers, and I don't care about the losers. I don't obsess over them. This week we're looking at Target, and we're looking at Target going sideways. And you can see for the past 6 months, or 5 months, excuse me, we've been in this nice range, right between about 140 and at the top of the range, 180, really about 170 right there. There's only a couple days that it was above there. So if it's going to be basing for us, let's take advantage of that. And so how do we want to play this here? I think the September, 145, 160, 175. So that's a little bit bearish. And you got 2 weeks on the trade right there. But if we go down 4 points or just hang out in there, you're going to be making money. And your profit area on this is pretty good. Your profit area is probably about from 152 to about 151 to about 169. So if you hold it till expiration and it closes anywhere in that range, it's going to be a profitable trade. So let's just let it meander about and make some money off the theta decay. Last week we were short RNG, that's Ring doorbells. And surprisingly, Ring was up almost 0.85%. So there's some time left on that trade. We'll see which way that one goes. But again, we really don't mind. It's just one part of many in our whole portfolio. This week we're looking at CRM, Salesforce.com, and this is just a classic breakdown. We haven't seen support like this since May. That support goes down to the 155. So this thing fell in 2 weeks from 190 down to 155. That's a huge drop right there. That's nearly a 25% drop in a very short period of time. And we couldn't even bounce on Thursday. So there's definitely a lot of weakness right now. We're looking at just a simple 2 week 150, 155 bear call spread. This thing has moved so much. That's kind of a wimpy trade. That's okay. We don't want to get over our skis on anything. We're just planning in the next 2 weeks. This thing is going to drift down to that 150 area. Again, this is going to be delta dependent. It's sitting at about 154 right now. So you're probably going to pull in maybe $3 in credit, have 2 at risk over the next 2 weeks, and that's fine. That's completely fine. We're looking at a lot of these things right now.
Darren, you rated the materials sector a -1. I also agree with you on that one. And last week, Newmont Mining has been a trade I've been watching for over a month, just waiting for this thing to set up on a low base breakdown. And it had its nice breakdown. We were short. Stock went down just under 4% at 3.6%. So nice trade on Newmont. I saw a lot of our traders joining us on that one. So it's always nice when we can get a nice trade under our belts with a big part of the group. This week, we are looking at Freeport-McMoRan. Now, this is a copper mining company, and it was kind of difficult to find stocks in this sector because everything's pretty beaten down. Now, look, what you don't want to do is try to short the strong stuff. But there's also at some point where you don't want to short the stuff that has been going down for like 3 weeks straight. And so I came across this Freeport and I thought, okay, we had this huge drop here from 42 all the way down to 26. We put together this, if you want to call this a 5-way pattern on Elliott Wave, that's fine. But anyway, we've broken that channel. And once we break that channel, it basically says there's a new downtrend likely to start. So the question is, okay, where do we get in? We just got that first break lower, but look at this candle on Thursday. That candle on Thursday is just a lousy candle. Remember, the market had a huge bounce on Thursday. This one was still red. Friday, it hardly gapped up, and by the end of the day, it had sold off. And so I'm looking at this thinking, okay, where do I get into this? This one's always a difficult one of where to get into. If you're looking to do straight puts, I think that you need to wait for a little bit more of a bounce, maybe up into this 29 area, 29.20 area. But that's not the trade I want to do. The trade I want to take a look at is this bear call spread. Just a very simple trade of 28 to 30. And this is really going to depend on where the stock opens on Tuesday. If we open below this, I might need to go down to like a 27. I might need to do like a 27.29 to get the right kind of credit. But I want to get at least $1 of credit on this bear call spread. Anything that I can do to do that, get that as a nice trade, because I do think this is likely to go down and retest at least this 26 area. So I think that is going to be a reasonable target on FCX. And in energy last week, we had a trade on NOV. We've been sideways in energy as well over the last couple of weeks. And that one went down a little bit, went down 5%. That's going to be right at the bottom edge of our profit area on NOV. But I agree with you, Darren. This is a +2 sector in energy. I wouldn't be surprised at all to see that sector bounce back a little bit next week. Staying with that, we're going to be with Chevron on sideways. As you can see here, this stock has held up nicely. The price of oil has come down. The price of oil has come down from 125. I believe we closed at 86 on Friday. This thing is pretty much immune. Now Chevron, they do a lot of gasoline. And when gasoline is slower to come down than oil, it's actually very good for the companies. It's called the crack spread. And that's what's been happening is oil's been coming down very quickly. Gas has been very stubborn to come down. That benefits a company like Chevron. Regardless, you can see the stock isn't really going anywhere. And so we really want to take a look at, okay, where do we want to put this butterfly? Now you have ultimate control over where you put this butterfly. I'm looking at the 140, 150, 160 butterfly. Now this is a slightly bearish butterfly. And I'm looking at this stock trading down about 3 to 4% over the next couple of weeks. So again, I'm looking at the September 16, 140, 150, 160. So the call here is that Chevron trades down about 4%. 4% is going to bring it down into this target area that our 140, 150, 160 butterfly will give us. This is going to be a really nice trade if it does just drift down a little bit. Oil is likely to, if the market does fall apart, likely to go a little bit lower. I think it's going to pull things down just a tiny bit more, so nothing too overly bearish. But the sector is going to outperform all the other sectors, in my opinion. Well, that is it for trades for us. If you have any trades you want to share, if you're a Maverick Trader, go on to the Maverick Trading website, log in with your username and password, and let's get the discussion going. We love when traders freely exchange ideas and help all of our other traders make some more money. It's why Maverick is here, to create this collegial atmosphere where we're all working together to help us all make some profits. So let's wrap this up. In conclusion, the markets are tilting bearish. I would love to go to a -3. I feel like it. My spidey senses are telling me it's about to get really ugly. Here's the problem. I trade the technicals. I don't trade my opinion anymore. And the technicals are telling me to be like -1, -2, that's it. I can get -2, -3 very quickly over the next week or two. But right here, right now, it's saying, hey, just be mildly or moderately bearish. Understand we are moving into a seasonally weak period. We've been talking about this for the last 3 weeks. We've been warning, hey, traders, watch out. September's nasty. September's ugly. September's are brutal. We're going into this September in a really weak fashion, so I would not be surprised at all if this follows the seasonality pattern. So look, be cautious. Now look, all that means is be cautious on the long side. That doesn't really mean be cautious on the short side. If you are comfortable on the short side, hey, let's be net short. Let's make a lot of money like we've done for the first 6 months of this year on the short side. And let's just follow the market down as far as it goes. When it bounces, we'll cover, we'll take our profits, and we'll move to the other side. That's what traders do. We just follow the market where it is. Thank you so much for joining us. We're producing a lot of content this week. We'll be sending that out to you periodically. So check your emails and check your text messages for that. Have a great long Labor Day weekend. Everyone be safe, and let's go make some money in September. Thanks, everybody. Goodbye.
Good trading, everyone.